Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and founder of Moore Square Communications. Each episode, we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Catherine Howarth, Chief Executive of ShareAction, to the show this week. Welcome, Catherine.
Thank you, Charlotte. Very, very pleased to be here.
And do tell us, what is your news story of the week?
Sure. So my news story of the week is Thames Water seeks $3 billion in emergency loans from creditors, which is a story from a couple of days ago and is probably already outdated because the Thames Water saga is nothing if not a roller coaster. And I think it's just been fascinating to watch as the shareholders have had their equity largely wiped out, it seems, at this point, and now the bondholders are scrapping over who's going to get some outcome or another. And the cost of interest for loans to this company are now in the territory that some are describing as predatory lending. So it's a sorry tale, and a lot of people in professional investment probably have their tails somewhat between their legs at this point on this.
Yeah, well, it's always, when the shareholders go and then the seniority of the debt is all scrapping amongst themselves for who's going to get which little bit. There's some great comments in the article about how it's only going to be the activist share hedge funds which win out. And I think there's some great below the line commentary as well, isn't there, Catherine?
Yeah, I do. I love the FT. It's a great newspaper, but it's particularly good because the people that read the articles add half of the value and always a lot of the entertainment. And they've been having a field day on Thames Water. And, it's genuinely quite a grisly story because it goes back a hugely long way to privatisation in 1989. And, the notion that this was going to produce incredible efficiency and cost savings, and we put it in the private sector, it's going to be so well managed. And it really hasn't worked out that way. And as someone that is a Thames Water bill payer, facing the prospects of up to 50% increase in service cost by 2030, it's not very pretty. Plus, there's the grisly business of sewage landing through the Thames Water area, and none of us like that, or the idea of it very much.
But it's a story of particular, it's a sort of very much a parable, it seems, a cautionary tale also for professional investors, for large institutions that have been very involved in this company for a while, haven't they?
Well, yes. So originally it was a publicly listed company post-privatisation, and lots of people, regular retail investors, bought in, and bit by bit, it sort of passed into private hands, and it's not been a listed company for a very long time, but it's gone through multiple eras of different ownership. RWE, the German utility, held it for a long period, followed by Macquarie, the Australian infrastructure specialist that's got quite a reputation for taking infrastructure assets and loading them up with debt, taking large dividend payments, and then passing them on. And who have they passed them on to? Well, a whole consortium of pension funds around the world, including the UK's largest pension fund, USS, the University Superannuation Scheme, many of whose members are also Thames Water customers and live in the Thames Water area, very interested in environmental performance of this company. And I think that really illustrates the complexity of the stakeholder landscape in modern institutional investment, and it has implications for fiduciary duty. I think acting in the best interests of members of USS is not only about trying to secure them a good return, and in this case, of course, USS have made really a very problematic investment from a financial point of view, but what about the interests of those members that are also customers? How well are they served by the current regime at Thames Water? So it's just full of interest.
And I mean, I know that the story is incredibly complex. I've seen charts of how the ownership structure is, and it's absolutely mind-bogglingly Byzantine. So you gave a sort of brief canter through the history there. Is there one particular thing that you feel where it all went wrong? I mean, I have my opinion, but it's interesting to hear where you think the Thames Water really just became a disaster.
Well, I think it's a kind of a long slippage, really. And a lot of it goes back to governance questions of who sat around the table making decisions. Because Thames Water is, in a way, a cash cow of a company. As long as you do keep making prudent investments in the infrastructure, you've got a total captive market in terms of a customer base. Those of us that are Thames Water customers have nowhere else to go for water and sewage. So it should be a tremendously stable investment that's really suitable. But of course, like any company, if you load it up with debt and then demands begin to grow for prudent and environmentally aware management of the underlying asset, things can go wrong, not quickly, but kind of slowly and bit by bit. And who knows? I mean, the government has just announced that they're going to review whether they will even continue to have Ofwat, the regulator that oversees the water industry in the UK. And there's lots of speculation about possible renationalisation. But this latest story I picked out is all about trying to hold off the so-called evil hour of renationalisation, in which I guess a huge number of financially interested parties would lose their shirts. So yeah, it's this shambles is not over by any means, and the story will run and run. But I do feel it's rich in lessons about the perils of financializing assets that fundamentally exist to serve the public interest in the provision of critical utilities that all of us need in our daily lives.
I mean, I think the Macquarie point is a really interesting one because, as you alluded to, you can't blame the leopard face eating party for eating your face, given half the choice. But to me, that speaks a lot to, and I think it's a very interesting parallel to bring out today, in that the government wanted to privatise, it wanted access to private markets for these big infrastructure plays. And as we've discussed in previous podcasts, that comes at a price. You have to pay a premium. But part of the problem that maybe I think is elided at times is the fact that I'm not convinced that ministers, policymakers, civil servants are as up to date with how the world of finance works as maybe they should be. And there is a sort of a feeling, isn't there, that maybe Macquarie was allowed to do something that it should not have been allowed to do. And that this dissolving of Ofwat is also a feeling that there was a conflict between how much actually needed to be invested to maintain our infrastructure and for our infrastructure to cope with climate change, and how much was palatable to consumers. And I think that's a big, complex area that we're going to have a lot of scrutiny of going forwards, and we need to be very cognizant of if this Labour Party is going to go ahead and get very involved again with private financing of these big infrastructure plays, which on the face of it should be great for pension schemes with their multi-decade long investment horizons. But there needs to be a consideration, and it all needs to be done well and every stakeholder considered.
No, absolutely. So one of the reasons this is so intriguing, the Thames Water story, which does run and run in the media, is that it sort of gives pension trustees really big nightmares. And the government keeps hinting at the idea that it will actually mandate investment of pension fund assets or pension fund capital into so-called UK productive finance, which is basically a bit of a byword for infrastructure and other, well, it's for companies as well, but what the government's looking for is to bring a lot of private finance into infrastructure to help with crucial things like the green transition. Notable, by the way, that a lot of Thames Water outstanding debt is green bonds. And that's what the government would love to see pension funds investing more into. But pension fund trustees have a duty to make prudent financial decisions, and life gets all the more complicated when you invest in assets that your own membership base has a critical interest in the underlying operating performance as customers of those infrastructure assets. So it couldn't be kind of more awkward as a story out there, just as the government is really hoping to try to attract more pension fund capital into these type of assets.
And we're recording this a few days before the budget, so it may be by the time this podcast comes out, which will be on Thursday or the day of the budget, the day after the budget, we'll have yet more to add to this story. But rather than being sort of accused of schadenfreude and delighting in others' misfortune, let's use this negative story and think about how we can do things better going forward. So what would your recommendation be for how professional investors can do a better job in the future?
So it's interesting, because I think that one of the really intriguing lessons of Thames Water is that actually investors have an interest in assets like this being governed in a way that brings all the stakeholders to the table throughout the lifetime of an asset. And in practice, what happened at Thames Water is that customer interests and sort of environmental and consumer interests didn't have a lot of expression at the table. I mean, they was sort of through Ofwat, but it's not been a story where those voices were heard until more recently, when there was a lot of really quite effective and high profile campaigning, which has driven up environmental requirements on the company and put a lot of pressure on Ofwat to require a lot more investment in maintaining these quite aged pipes and sewer systems, which keep flooding when we have lots and lots of rainfall, and rainfall patterns are certainly being affected by climate change. So one of the lessons that I would say is that it's actually in the interests of investors for a wide range of stakeholders to be at the table over the long term. It seems attractive to be able to kind of take advantage of the investors, particularly shareholders, have lots of access to management, lots of opportunity to press their interest, in this case to press for dividend payments. But ultimately that leads to a very unsustainable way of managing the company. And I look back and say, I think it would have been much better if Thames Water was governed in a way that brought all those interests to the table, and we would be in a position where some of the investments would have been made in a more prudent way further in the past, and we would not be in the pickle we're in today. So good governance, accountability, and multi-stakeholder management of complex assets like this, I think, is one really interesting lesson that I draw from it anyway.
Yeah, I think on the capital expenditure is a good point. Infrastructure is kind of a cash cow, but it's kind of not either, because if you're going to have to invest so much, I mean, the classic story you see spouted in the news stories all the time is how few reservoirs we've built, how we haven't built anything, I think, since the 1980s. To be fair for Thames Water, we do have the super sewer, which is due to come online in 2025. But generally speaking, there is a lot of infrastructure that is going to have to be built, and a lot of innovative thinking if we're going to basically turn into a temperate subtropical zone where we have a rainy season that lasts from October to March because of climate change. So there needs to be a lot of honesty about that, I feel. And as you say, that's a difficult conversation to have, isn't there? Because there's lots of competing concerns with someone like Thames Water.
Yeah, and they haven't really had a way to express themselves, because this asset has been in private hands, so there hasn't even been an annual general meeting that people could go to. My organisation, ShareAction, makes fantastic use of listed company AGMs to ask questions that are relevant to different stakeholder groups. And that's not possible when companies are in private ownership. And that all feeds into a bigger story about why don't we have more companies publicly listed, and what do we do about the fact that the accountability issues that arise from a capital landscape where far more companies are now in private hands.
Yes, I mean, the counter to that people in the industry would say is that you can actually have more control within a private company, whether it's private equity or private debt, because you can get onto the boards and you can put ratchets, for example, for private debt, and you can just have more direct dialogue. But that may well be true, but unless you're being transparent about that, it's very difficult for somebody, an asset owner like a pension scheme, to know exactly what's going on behind closed doors. So there is a greater onus, I guess, on managers of private assets to be more transparent too, isn't there, Catherine?
Oh, absolutely. And I know people are grumbling away about regulation from the European Union, but the European Union is insisting or bringing in regs that will place a far higher level of disclosure requirement on large privately listed companies to make it a bit comparable to what public companies have to report. And I think there's a huge public interest in that, and also ultimately a prudency as well, that when things are hidden from view, this is where you store up problems, and there is no better poster child for that than Thames Water.
There isn't indeed. So from a governance perspective, can you give us some more sort of concrete proposals of what you would like to see changing going forward when it comes to these infrastructure companies?
Yes, well, I mean, so the UK government has just announced a major review, and I think it will be really, really interesting to put multi-stakeholder governance at the heart of the forward thinking about how do we get a utility, and particularly water utility industry in the UK that serves the needs of customers, investors, the wider public, and I think there's a real opportunity to do that afresh and to get kind of buy-in, because we are going to have to see what we know we're going to see our bills rising. How do you make that palatable? One of the ways is by having transparent governance where everyone feels they're part of the decision making in some way, or more parties have a bit of agency. But that leads me on to thinking about the pension fund industry more broadly, where we've been saying for many years at ShareAction that we need a bit of a broader think about fiduciary duty, that we tend to define it in law very narrowly as the obligation of trustees is purely to returns maximise at the portfolio level, ignoring the fact that many investments, and it wouldn't just be water investments, it would be right across the board, that we make through our pension funds, are companies that have real impact in our lives. And we need an approach to fiduciary duty that allows those different interests to be weighed up, whether it's our interest in decent employment conditions, or environmental management, or just decent outlook towards consumers, or management of privacy issues in the tech sector. We are invested in these companies through our pension funds, but we're also living and breathing and using all of these companies every day. And I really think we need a 21st century approach to fiduciary duty that recognises that we invest for a return, but we also have an interest in those companies behaving in a responsible manner.
To be honest, though, I mean, given that we've got the bondholders with knives drawn, all fighting for the scraps, like hyenas over a lion's carcass. I mean, this is a story of not, good financial management either. I mean, that's the point. You talk about fiduciary duty, but Thames Water being in the case where the shareholder equity has been wiped out and it's bondholders fighting for what's left, and renationalisation because basically the whole company is deemed to be almost worthless. That's a story of classic financial collapse. So maybe in a weird kind of way, what you're saying is we need this more holistic definition of fiduciary and governance to actually be better at the underlying job of investing in a company that's going to have longevity and is going to keep pace with the people who it's invested in, so that the 20-year-old in their pension pot is still going to have Thames Water around by the time they hit 60, which, may be completely unrealistic. But it's interesting to me, the interplay between the purely financial and the behavioural, if you see what I mean.
I could not agree more that I think what I'm proposing in taking this kind of more balanced approach is absolutely not some kind of altruistic outlook that says, oh, I'm not interested in good returns. Far from it. I think that we protect our returns over the long term by having good governance, by considering stakeholders, by having companies that don't financialize and have intermediaries, short-term owners, pillage them and then sell them on to, very often, in this case, I think somewhat naive pension funds who hadn't done their due diligence. I mean, this can't be in any way considered a smart investment move to have bought Thames Water a few years ago. So it's definitely egg on face from a financial point of view, but there's a much bigger story, and I think it's a cautionary tale that those stakeholder interests are actually one way of ultimately protecting your asset.
I mean, I guess the counterpoint, if I'm sitting here and just trying to play devil's advocate to what you're suggesting, given the point that we've just agreed on, that by being more holistic and more focused on behavioural and wrapping in more stakeholders might actually result in better financial good sense. The counter argument could be that by the time you've got 20 people around the table, it becomes virtually impossible to make a decision or prioritise who needs comes first or all the rest of it. What would you say to that criticism?
So I think good governance is complicated, and I don't think it's easy, and you can end up with people that just shout the loudest in a scenario like that, having more influence than makes sense. But I also think there are some quite sophisticated and interesting new ways of managing multi-stakeholder interests through things like deliberative democratic decision-making, citizens' assemblies. Some of that thinking is beginning to infiltrate the financial world. I've been very, very intrigued by a Dutch pension fund that, where the trustees of the scheme recently commissioned a third party to identify 50 members of the scheme that were picked through sortition to be representative of the scheme as a whole, and to spend 3 days learning about and deliberating on the scheme's approach to sustainable and responsible investment, and coming up with a series of ideas for the board. Now, the board, this is not a multi-stakeholder board, it's a traditional board, but it's found a way of bringing the voice of its members in and actually building consent for its approach to sustainability. I think that's a particularly intriguing and enlightened example. But you're right that having lots of interest around the table makes decision-making more complex, but ultimately potentially more resilient and robust, because you've not left key parties out who will then distrust the decisions that have been made. And so I think the long route done well is the smart route.
So is maybe a more efficient way to do this, so you don't end up with too many voices, and I take on board what you say, that it may take you longer to get a decision, but that decision may last longer. Maybe this idea of a core board, but people feeding into that in the same way that you have a trust, you have a board, and you have a separate investment committee within a pension scheme. Because you don't want the scheme member voice. That's interesting, but you also want the experts to be able to express their opinion too. To go back to what we were saying, the fundamental problem at the heart of this is we need an infrastructure company that's going to make the necessary type of capital expenditure investment over time, and it's going to be able to think laterally, particularly with flood risk, about how it manages that, and be open to lots of different ideas. So maybe that's what we need, some kind of, the individual scheme member be able to put in their point of view, and then have these committees, these specialist committees that understand, the flood risk or what's involved in infrastructure investment and all of that, just much more holistic approach to investment.
Oh yeah, well, we certainly need to bring expertise to the table, and I think part of the problem at Thames Water, looking back, is that the company was managed just as a sort of financial asset, and costs were cut. There was always an investment program, but it was pared back at a critical juncture. Whereas if you'd had more of those expert voices who are, technical people in engineering and in climate science, more of those different expert voices, as well as the consumer interest, I think ultimately we perhaps would have had a more prudent and sustainable management of that institution. But look, let's face it, it's always easy to look back with the benefit of hindsight. And but it's equally incredibly important that we do learn the lessons of what was a kind of wild experiment, ideologically driven experiment, privatisation of monopoly utility assets. And the UK led the world. And it would be really intriguing to think what overseas observers of this make of this pretty sorry story.
Well, I think that is a superb point for us to end our discussion. It's been wonderful to have you on the show, Catherine. Just great. Welcome to the first new woman to the show apart from me. That's very exciting. And fantastic discussion, very enjoyable. Listeners, if you want to make sure you never miss a future episode, then please hit the subscribe button. Thanks again, Catherine, and thanks to you for listening.